Hi, everyone. Thank you so much for joining us today. We are very excited to host this webinar. After this webinar, we will be at events and doing some exciting things for the end of the year. And before you know it, we'll have those last 4 new webinars in our 7 pillar series that we're putting on. But today we're going to do sales tax versus income tax. And before we get started, I'm going to go over some housekeeping items and do some quick introductions. So first and foremost, if you are here for CPE credit, we do need you to do a few things in order to receive that CPE credit. We will need you to answer our poll questions as they pop up on your screen. If you have any issues with that, just send me a message and we'll get that sorted out for you. But you do have to answer those poll questions again in order to receive that CPE credit. Another thing that's important to do if you want that CPE credit is to fill out the survey at the end of this webinar. It will pop up for you automatically as you are exiting. Again, you do have to do that survey in order to receive that CPE credit, and it's a great opportunity to leave feedback as well. And let's go over a few more housekeeping items here. If you have questions as we're going along, please reach out and ask those questions. We're going to do our absolute best to address them at the end of this webinar. Oh, Mike, am I still there? Let's see. Oh, I have some responses that I am. Okay, I'll keep going. We're going to do our best to address these at the end of this webinar or follow up with you via email. We will also be sending out the slides 24 hours after this presentation, but you can also find them in the chat feature and upload it directly to Zoom. So you will have a few ways to get your hands on those slides. And let's do some introductions here. And it looks like my notes have signed me out. So we're going to do this all from memory, which will be totally fine. So a quick introduction for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we have a little list here, but you can see we do a lot of sales tax returns, sales tax registrations, consultations, and more. So if you have questions about our services or you'd like to work with us, please reach out and ask. We would love to work with you as well. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded, and he is especially well-known in the e-commerce community. He's helped thousands with their sales tax issues. And I think I got close enough there, Mike, but I'll turn the time over to you and we can go ahead and get started.
All right. Will you be back for the poll questions?
Absolutely. Yep. Zoom's
Okay.
having no issues. Everything else is.
Okay. Thank you for the introduction, Ellie. We've got a lot of information we're going to go over today. I'm going to keep my camera on for just a little bit here, but we're having some connectivity problems. And I find that you can hear my voice better when we're not using the bandwidth for video also. So I'm going to turn that off shortly. First poll question, I'll probably turn it off. Today, we're going to cover a definition of nexus. We're going to go over sales tax nexus very quickly. We're going to spend some time on income tax nexus, and Public Law 86-272 is a federal law, and no discussion of income tax nexus would be complete without a large part of that discussion going to Public Law 86-272. We're going to talk about the MTC's historical guidance as it relates to Public Law 86-272, and then their current guidance as it relates to Public Law 86-272. We're going to talk about some aggressive income tax states, and then we're going to briefly touch on personal income tax returns, because if you've got a responsibility for corporate income tax returns and you're in a pass-through entity, you've probably got responsibility for the personal income tax returns for the members and or shareholders. Then we're going to open it up to questions. So a lot of information today. We are going for 90 minutes. We are giving 1.5 hours of CPE credit. And hopefully at the end of today, you're going to understand that there are different Nexus standards out there. The standard for income tax is different than that for sales tax. We hope that you all understand the protections of Public Law 86-272 and also the limitations of Public Law 86-272. And we'll get into what exactly that is. And we hope that you understand where you and or your clients have exposure to either sales tax and or income tax. And it's important to know what's your Nexus footprint, where you might have a responsibility to either collect tax or pay tax. And the reason why that's so important is because you don't want to find out that you've got problems when a state's sending you a Nexus questionnaire or sending you a piece of mail or picking up the phone and calling you. At that point, you're being reactive, and there are not very many options to mitigate any past exposure you have. There are options if you're being proactive. So knowing what your Nexus footprint is the first step, because if you know you have a responsibility or requirement to do something, then there are options you can take in order to mitigate some of the past exposure. So we say the worst time to find out you have problems is when the state's at your doorstep there. All right, Ellie, let's go to the first poll question, and I'm going to be turning off my camera.
Yeah, absolutely. So we want to get a feel for everyone here. How would you rate your Nexus knowledge? Your choices are: what's Nexus? You know the basics. You have an intermediary knowledge, or you are a Nexus expert, or, like I'm sure you've heard us say, an expert. Mike, a lot of people falling somewhere in the middle. We do have a couple of experts out there. And why don't we give this a few more seconds and then we can close it out and move forward. Quick reminder for everyone, you do have to answer these poll questions in order to receive CPE credit. So Mike, why don't we close this and move forward?
Okay. Well, for those of you who are fairly new, let's start with the definition of Nexus. And Nexus is just a fancy word. It means link or connection. And when we're talking about taxes, it's the link or connection that must be present before state can require you to do anything. For example, before it can require you to collect its taxes, like a sales tax or a use tax, or pay its taxes, like an income tax, a franchise tax, a consumer use tax, you have to have some sort of link or connection with that state. And we call that link or connection Nexus. So that's why we say this all starts with Nexus. Because if you do not have any Nexus, or if your clients do not have any Nexus, then the states cannot require them to do anything. So no Nexus equals no problems and no responsibility. Now, the problem is, not everybody knows what their Nexus footprint is. Not everybody knows where they may have responsibilities to be collecting or remitting. So that's hopefully what will help you understand or help you educate your clients on. There are two types of Nexus when we say it all starts with Nexus. When we're talking about sales tax, we really have physical Nexus, which is sometimes referred to as old-fashioned Nexus. Up until 2018, you had to have some sort of physical component to create Nexus. Now, we can argue over what does and does not constitute a physical component, but that's what you had to have. With 2018, we had the Wayfair case come in, and that overturned the two cases, National Bellis Hess and Quayle. Those were the two cases where the U.S. Supreme Court said that you had to have some sort of physical presence. Well, it overturned them, this Wayfair case. And by overturning them, in theory, states could go back to 1967. That's when the National Bellis Hess was. And it's, in this case, the Supreme Court in general, I mean, after we've got the Roe v. Wade, I guess they do change their mind. But prior to that, it was rare for the Supreme Court, U.S. Supreme Court, to ever say we were wrong. And what they did, they didn't come out and say, hey, times have changed, so we're going to change this. What they said was we should have never introduced the concept of physical presence to begin with. We made a mistake. So it's like these cases never happened. So the states could have went back to 1967, as I was saying. Now, South Dakota was the state involved in the Wayfair case, and they were pretty smart. They said they were only going to do this on a prospective basis. So what were they going to do? They were going to base this link or connection on a certain level of sales or a certain level of transactions. So they thought that $100,000 or 200 transactions were fair. Now, the U.S. Supreme Court didn't explicitly say that that was fair. They sort of gave South Dakota a wink and a nod, though, and they did send it back to the lower court to be settled. But that case was actually, settled before this was addressed. So we may see some more litigation on this. But here we are 4 years into it. Most of the states have pretty much implemented this in a smart way to keep, the Supreme Court and Congress from going back and redoing it. We saw a lot of states jump on the bandwagon and follow South Dakota with $100,000 or 200 transactions. We're seeing a trend away from that now. Now, not totally. About 45% of the states still have this $100,000 or 200 transactions. But we're seeing states like California, who was at $100,000 or 200 transactions. They said, hey, this may be okay for South Dakota, but we're the biggest state out there. More revenue comes from California than from any other state. So we're going to get rid of the transactions, and we're going to raise the dollar threshold to $500,000. And we're seeing more and more states take that approach. But some big states like in New Jersey and Illinois, they still have this $100,000 or 200 transactions. So every time I start to say there's a trend away from this, people start ignoring it, and you can't ignore it. It's still in some very big states in there, and roughly 45% of the states still have this. Now, on an economic nexus, we have these thresholds, but what's included in these thresholds? I mean, states don't make it easy. Every state is a little bit different. In some states, non-taxable sales are sometimes included, sometimes they're excluded, sometimes gross sales, every type of sale. Sometimes it's we're going to include exempt sales, but we're not including sales for resale. Some states include sales through a marketplace like an Amazon or an eBay, and other states may exclude them. So it's really a tough mix. And Ellie's going to get you out a chart that we've put together that can really help you out. All states with a sales tax now have thresholds. Missouri's is not effective. It becomes effective this January 1st. This is a thing that I think is here to stay. I do not. There's two surveys out there. One of them says 50% of companies are not compliant. The other says 60% of companies are not compliant. And when we talk to companies, when we talk to accountants, and ask them why they're not moving forward, sometimes it's because they just didn't know about this. But more often than not, it's because they think the Supreme Court's going to step back in and change it, or they think that Congress is going to pass something to solve them of their problems. And I don't think that's going to happen. When we get to the income tax portion today, when you start talking about public law, that we'll see why I don't have a lot of faith in Congress. But a couple things before we get there. When we're talking about economic nexus, just yesterday, we had someone say, it was an attorney, that this prospective client of ours who was talking to this supposed tax attorney. The tax attorney says, you're not subject to that internet tax. You're not selling on the internet. And we hear this so many times, but here's a guy, he's supposed to be smarter than the most people out there. He's a tax attorney. This is his business. He should know it. There is no such thing as an internet tax. Okay, this is not even an internet issue. It's a multi-state issue. And you don't even have to have a website. You can be selling by referral 100%. You can be selling by phone 100%. You could have infomercials. You could be selling by catalog. I mean, literally any way you think of selling that's not over the internet. If you're selling into multiple states, this could impact you and or your clients. It is not an internet tax. And we hear that a couple times a month still 4 years into this. So that's number one point I want to make. The number 2 point is this does not override any other type of nexus. It doesn't protect you from anything. And a couple times a month also, it used to be more frequently, but here we are 4 years into it. We're still hearing this. People will call up and say, well, Mike, I'd like to deregister in Texas and California. And we say, well, how come? And they say, because the thresholds are 500,000 in both states, and there are no transaction thresholds. So we're underneath both. Well, we're underneath the dollar threshold, and there is no transaction threshold. And at that point, it's a current client, and this comes from current clients even. I say, well, last time we spoke, you had independent contractors traveling into the state on your behalf, or you had inventory in a warehouse. Oh yeah, we still have that. That's still going on, but we're underneath the thresholds. And I have to break it to them, and I have to say, well, it doesn't actually work that way. This is just one more way for the states to get you to do what they want you to do, which is collect or pay their taxes. So it's not protecting you from any other type of nexus. As a matter of fact, a physical presence is going to trump an economic nexus when it comes to sales tax almost every time. So here's the chart I was talking about. We update this every time there's a change. There's a lot of great information on here. And by the way, a lot of software companies out there tell you how great their software is, and they can tell you when you have Nexus somewhere. In general, I have not seen any software out there, and I have tested a bunch of them. I don't see any software that gets granular enough in order to rely on the software alone. When you do, you usually end up getting registered in too many states because it can't get as granular. If you look at what's included or excluded from the threshold calculation, let's look at Alabama. Taxable and non-taxable retail sales. Excluded sales for resale and sales through a marketplace. Alaska included gross sales, including sales through a marketplace. Arizona, gross sales with Arizona customers exclusive of marketplace sales. I mean, I think you get to see the point here. Every state is so different. You're not usually getting enough inputs into the software for the software to give you a correct answer. So software is great to identify an issue for you. It's a big red flag, throws up a red flag. But then you got to grab something like this chart and see if your actual fact pattern requires you to be registered or not. So software, great red flag, draws your attention to an issue. And then you've got to either get someone like us or use a chart like this to make sure that you're not getting registered needlessly. You'll see that the monetary thresholds change over the time, the transaction thresholds change over time. Calculation methodology, that's basically 3 types. In some states, you're going to look at the previous calendar year, and those are the easiest ones. Every January, you want to see if you passed any thresholds during the previous calendar year. And if you did, then you should be, if what you're selling is taxable, you should be getting registered. That's what the state says, and collecting and remitting the taxes. If you're not over the thresholds in the previous calendar year, you don't have to look at this again for a whole nother year. The following January, you do the same process all over again. Now, the next group of states are previous or current calendar year. And the previous year, just like the one we just talked about, you want to look back the last 12 months. And if you're over it, then you should consider getting registered. If you're not over it, then it depends on how quickly your sales are growing. If your sales are growing very quickly, then you should be checking this more often than the following January. But if your sales are slumping, or if your sales are growing very slowly, then maybe you don't check it until next January. I'll give you an example. I think this was 2 years back now. I had a company that was on Shark Tank, and I wasn't aware of this, and they sent me their data for the previous year, and it was like April. They didn't send me any year-to-date information, and they were a fairly small company. They were registered in 3-4 states, and when I reviewed their data, I told them to get registered in another 2 or 3 states. They had crossed the thresholds, and the salesperson said, "Mike, no, something's wrong. Their sales are exploding, literally exploding." So I said, "Okay, give me the year-to-date sales." That's what we usually do. That's what we had asked, but they had not provided them. And when they did provide them, that 4 months made a huge difference, because their sales were growing so quickly. I now told them, based upon the thresholds you've crossed year to date, you should be in almost 20 states. So huge jump. So it all depends on how quickly your sales are growing when you're looking at previous or current calendar year. Now, perhaps the one that's hardest to follow is previous 12 months or prior 12 months. A state like Illinois is going to tell you that every quarter you've got to check this to see if you have crossed this in the preceding quarters, the preceding 12 months, but you're looking at it on a quarterly basis. So those are perhaps the hardest to follow, but there's great information on this chart. If it gets a little bit outdated from the one that you get today, you can just go to our website, and it's on the complimentary portion of our website, and just download it. We'll have the most current version out there for you. Now, let's talk a little bit more about economic nexus. One of the things that South Dakota did is they said to the Supreme Court, you don't have to worry about us going backwards. We're not going to go backwards. We're only going to do this prospectively. In other words, going forward. But it's prospectively from the effective date. And on the effective date, which in South Dakota, it's not the first state out there. They actually didn't go effective with this until November 1st, 2018. But they're going perspective from the effective date. And back in 2018, no one had any past exposure whatsoever in any state. But Now we're 4 years into this, and um, in going on 4.5 years in some states. So uh, that that exposure is starting to build, and some states are getting very, very aggressive. State like South Dakota, they stop you during the uh, registration process. A lot of companies decide they're going to just register on a prospective basis. We have companies ask us to do that for them all the time. And sometimes that's what you want to be doing because maybe you just crossed the threshold. So it's easy to get lost in the shuffle and not address any of that past exposure the way the states want you. South Dakota, though, will stop you during the registration process and sometimes make you prove that you didn't have Nexus since 2018. States like South Carolina will question you. Sometimes you got to do a sales tax registration rather than a remote seller registration to avoid that issue. States like Wisconsin actually have moved on from questioning registrations. They'll let you register, Illinois will let you register and then they're going to audit you 2-3 years down the road. At least that's what they're doing now. They're auditing everybody to make sure they use the actual date that they had Nexus as their start date. Maine is auditing also. So with our clients, we generally have them do, it's a smaller state. Sometimes if it's a bigger client, we do a VDA. Sometimes we just do what we call a historical registration, which is using the actual date their Nexus began, and then asking for a penalty waiver, which Maine has been good granting. We're also doing VDAs or historical registrations in South Dakota, Wisconsin, and Illinois at this point, because it's not a matter of if you get contacted by the state. In these states, it's a matter of when you get contacted. So other states are starting to purchase lists. Florida has a list. Utah has a list. Connecticut has a list. So you don't want to procrastinate here. We think more and more states are going to go the way of Wisconsin and Illinois and Maine and start auditing people. So you want to be proactive. You want to be able to take care of this. There are programs where you can limit your exposure if you're being proactive. All right, so let's talk about some of the physical nexus, because like we said, it doesn't protect you at any of this economic nexus. It actually is just one more way for the states to get you to do what they want, but it's not going to protect you anywhere. And while having 4.5 years of exposure is bad because of that economic nexus, what happens if you've had physical presence in a state for 10 years? And when the states are coming after people, they're going to stumble across all types of nexus. And in my entire career, the one activity that trips up more companies and their advisors, because it just doesn't make common sense, is third-party nexus. And this is where the activities of third parties can create nexus if they're helping you to establish or maintain a market. There are actually 2 Supreme Court cases that say this. One was the Scripto case back in 1960, 60 or 67. I'm sorry, they're running together right now. And what they said, Scripto was the pen company, and they had 10 independent contractors in Florida, and Florida said, hey, those 10 independent contractors, that's enough of a significant presence in order for you to be collecting and paying our taxes. And Scripto said, you're out of your mind. These people don't work for us. We have no control over them. How in the world can a true arm's length transaction be creating nexus for me? Well, unfortunately, the state of Florida won this case. You know, the Supreme Court came in and they said it's constitutionally insignificant as to what you call these people. They're performing the same function. And that's where we saw the beginning of attributional nexus, agency nexus. I keep it simple. I call it third party nexus. And on the list here is a list of activities that can fall underneath that umbrella. By the way, the 1967 case, 87 case was Tyler Pipe. And Washington went after a Texas company, Tyler Pipe, and Washington said, hey, according to Scripto, you need to be collecting and paying our taxes, business and occupation tax in particular. And this Tyler Pipe said, oh, no, this is not like Scripto whatsoever. We only have one person and they don't represent us exclusively. They represent multiple companies and they're not very good at what they do. They hardly send us any business. It's like a part-time person almost. And again, it goes to the Supreme Court. Supreme Court decides for the state. And this language is very, very important. They said, you know, it doesn't matter how you pay them. I'm paraphrasing the first part here. It doesn't matter how you pay them. Doesn't matter what you call them. Doesn't matter if they represent you exclusively or multiple parties. Doesn't matter if they do it on a full-time or part-time basis. Here's what matters. Are they helping you to establish or maintain a market? And the reason why that language, helping to establish or maintain a market, is so important is because so many of the states picked that line up and they incorporated it directly into their statutes, their rules, their regulations, the guidance they provide. And what better case to use as precedent? I mean, if someone goes to state court, you know, they're utilizing it in the state courts. So very, very important language. Rather than get into this list here, and this is only a partial listing of items that fall underneath the umbrella of helping to establish or maintain a market, what I tell our clients is that if you have someone going into a state and working with your customers or the public, then that is probably going to be a nexus creating activity. But it's not all third-party activities. For example, if you hire someone to do your books on a 1099 basis or develop some software for you on a 1099 basis, well, these people aren't generally thought to be helping to establish or maintain a market. They're more, you know, behind the scenes, and they are generally not going to be nexus creating. So it's not all third parties, but anyone who's interacting with the public or your customers, good chance that they are going to be creating nexus. And since there's two U.S. Supreme Court cases about this, most states, this is something that they just, you know, believe is nexus creating. Very common nexus creating activity. So third party, I mean, again, it's the number one problem for companies out there with nexus problems that I have found. It creates bigger issues than anything else. And I think the reason is it just doesn't make sense. When we're thinking about what creates our nexus footprint, what activities we have, we don't often think of the activities of true arm's length transactions. All right, so some other things, where you have employees, locations, or where you live or operate your business from can create this physical nexus. We've run into this quite a bit more recently because everybody does everything in the cloud. So a lot of people tell us, well, Mike, I don't have a link or connection anywhere. Everything I do is in the cloud. Well, unfortunately, that's not the way the states look at it, because you yourself are creating a link or connection with the state. So where you live or operate your business from is creating that link that we call nexus. Now, owning of tangible personal property in a state. So if you are leasing things into other states, that can create nexus, but also inventory in a state. Now, even since Amazon's collecting the tax now, the inventory can still be creating a problem for you. Now, FBA sellers just won a case, but the title here, inventory in PA, Amazon warehouse does not create nexus because, the Online Merchants Guild won a case, or does it? So I'll give you a little bit of background. Pennsylvania was pursuing sellers for sales tax and income tax based on Amazon inventory. Now, they offered a special program, and if you entered this program, they weren't going after the old Amazon stuff. But let's say that you had $45,000 in sales through Shopify, and Pennsylvania is one of those states that doesn't include sales through a marketplace in their thresholds. So if 45,000 at Shopify, you would not have economic nexus. So what Pennsylvania said is, yeah, inventory creates nexus, even if it's in an Amazon warehouse. So that Shopify, now you got to pay, collect and pay tax on it, even though you're underneath the $100,000 threshold, because physical nexus overrides economic nexus. Now, the Online Merchants Guild, OMG, they filed suit, they won. And the state came back, and this was, most of us, so-called sales tax experts, most of us thought that Pennsylvania would appeal, but they didn't. The state basically said, we don't need to appeal. We're going to change our approach, and we're going to look at this a little bit differently. But most of the experts, and we were wrong that Pennsylvania wouldn't appeal, we think that Pennsylvania is going to continue its pursuit of sellers. Now, Paul Raffleson, he's one of the attorneys for the OMG. He's the executive director for the OMG. Even he doesn't believe that the department has dropped its campaign to seek both sales and income taxes from thousands of online sellers with no physical presence. He actually said, I think they're just going to make more dumb, boneheaded decisions. He's talking about Pennsylvania. So for those of you who think that you don't have to worry about inventory in Pennsylvania anymore, maybe not so fast, because from all signs, it looks like Pennsylvania is just going to adjust their approach, but they're not going to change their pursuit of sellers with inventory. So we're going to keep a close eye on. We're going to see what Pennsylvania is doing. I've had some people, I've got videos out there and sending me emails and posting comments out there saying, hey, this isn't true anymore. Well, unfortunately, we don't know what the truth is right now, because it appears Pennsylvania appears that they're going to continue coming forward. And even Paul Raffleson, he's the the executive director for the company OMG that actually won the lawsuit. Even he's saying Pennsylvania is going to come. So I think this is a wait and see. I don't think we can mark this up as 100% settled. Yes, the lawsuit was won, but this is not yet a settled issue. And there are other states like California. California is very aggressive in going after companies that have inventory in Amazon warehouses. There's a Supreme Court case out there, National Geographic 1977 case. It says that the nexus creating activity does not have to be related to the taxable activity. So the inventory in the Amazon warehouse that creates the nexus, and then your sales through other channels, that's the taxable activity. All right, so Ellie's going to get you some handouts here. These are also up on our website. This is 10 common nexus creating activities for sales and use tax. And when we say common, these are the activities that most states, if not all states, look at them as nexus creating. And that's in direct contrast to these activities. These are 12 state-specific nexus creating activities. And the states look at these very, very differently. Each state looks at each item very differently. So again, Ellie's going to be getting this out to you. Sales tax nexus summary. We want everyone to remember that physical nexus is still alive. The Wayfair case did not do away with physical nexus. It's physical activities can still create nexus. It got away the requirement for a physical component, but not physical nexus in and of itself. And I think that's where companies' greatest exposure lie. Economic nexus not going away, despite what a lot of people were telling us, well, we're going to be saved by Congress. We're going to be saved. Certain states, I think Illinois is going to be challenged because the way they implemented seems discriminatory against interstate commerce. If you've got an in-state inventory, you collect their retail occupation tax on an origin basis. And if you're truly got economic nexus, you collect the retail occupation tax on a destination basis. There's almost 4,000 destinations. To me, that's extremely discriminatory. So I think they will be challenged, not because of the economic nexus, but because of the way they implemented it. And then, of course, you get the home rule states. They're probably going to be challenged also. But on a whole, the concept of economic nexus is not going away, and it's not going away in the majority of the states. Independent contractors are a major risk factor for and other third parties, major risk factor for companies. And inventory, major risk factor for FBA sellers, despite what happened in Pennsylvania. California is still coming strong, and there are other states that look at that too. And Ellie, why don't we go to our next poll question?
Absolutely. That should be up on everyone's screen right now. The question is, what about sales tax nexus concerns you the most? Quick reminder to everyone that you do have to answer these poll questions in order to receive CPE credit. Your choices here are nothing, you have down, economic nexus, third party, travel, or other. Mike, let's leave this open, continue to leave this open for a few more seconds here, but most people are answering economic nexus and third parties. And yeah, let's give everyone a few more seconds and then we can close it out and move forward.
Yeah, and those are the two big ones. I mean, economic nexus, because it's fairly new and it keeps changing. And then third parties, because it just doesn't make common sense. I mean, we don't think of other people creating nexus for us. We usually look inward, what do our employees do? What do, what activities do we have? So third parties often get overlooked. All right, so I want to talk about something right now, and this is my thoughts. You're not going to hear any state talking about this. And we generally look at sales tax a little bit more conservatively, because the numbers can get material much lower than an income tax. And what we're talking about is materiality, especially with a transaction, 200 transactions. What happens if you're selling a $5 item? You get $1,000 worth of sales. Now the state tells you that you got to go out, you got to get registered, and you got to file returns. Well, if the cost of compliance exceeds the back tax plus penalty and interest, does it make sense to file? My answer to that is no. I mean, just because a state says you should do something doesn't mean it makes good business sense to do it. In some instances, you are better off waiting for the state to come and find you and you pay the tax out of your own pocket plus penalty and interest. Now, I'll do a quick example here, and hopefully this will clarify a little bit what I'm saying. On $1,000 in sales, 200 of a $5 item. If we use an 8% sales tax rate, we're talking about $80 in tax. Now, if you don't pay it and you get penalty and interest, put 100% on that. So $160 per year, roughly. And that's what your exposure is. Now, if we go out and get registered and do what the state wants us to do, there's a cost there, whether you hire someone like us or whether you do it yourself. I mean, time is money. You could be doing something else while you're getting registered, but that's not the big part of it. The big part of it is the actual filing of the returns. Because some of these states, you're going to be monthly right off the bat. A state like Georgia, for the first 6 months, you're going to be a monthly filer. So now someone has to file that return every month. So even if you get the cheapest company out there to file your returns, or if you do it yourself, again, time is money, you're spending much more than $160. So why in the world would you, pay $300 or $400 minimum over the course of a year to pay $160 worth of tax over the course of the year? To me, I'm going to save money by paying you out of my pocket plus the penalty and interest. And it doesn't matter how many years this goes, unless your numbers get material. I am not saying don't ever get registered. Don't ever, be compliant. I'm saying if it's not material, don't worry about it. I am saying if your exposure is material or headed to be material, go ahead, be proactive, get registered, and do what the state says. Now, what I was saying here is we want to be a little bit more conservative. This is generally how I approach our clients because, sales tax is based on your gross numbers. So let's say you have $100,000 of sales and it's an 8% tax rate. There's $8,000 of tax before any penalty or interest. But if you look at that same $100,000 for income tax, let's say that you've got a 10% profit margin. So now you're looking at $10,000. And if we're looking at a 10% tax rate, you're only looking at $1,000. So 8,000 versus 1,000. Now that's a very simplistic example there. But if I think you get the gist here, gross versus net. And there's a huge difference between the two. So the exposure for the sales tax usually greater than the exposure for the income tax. Now let's go to some court cases. These are income tax cases. This first one, probably one of the most important, at least as of today. This is Northwestern Cement. And the company had an in-state office with salesmen soliciting orders of tangible personal property. The orders were approved outside of the state and fulfilled from a point outside the state. So remember that this fact pattern, very, very important. The U.S. Supreme Court came out and said these taxes did not violate either the Commerce Clause or the Due Process Clause of the Constitution. And that created an uproar. Within 7 months, Congress passed Public Law 86-272, or the Interstate Income Act of 1959. And this basically nullified the Northwestern Cement opinion. Now, when Congress passed this law, they said, this is just a temporary solution. Nexus is so complex. Nexus is so confusing. We're going to have to form studies and empower panels and have commissions. I mean, we're gonna, have to really get our arms around this before we come out with a permanent solution. So for those of you who are waiting for Congress to do something, they gave us this temporary solution in 1959. Here we are 63 years later. And if anything, Nexus is much more complex today than it was back in 1959. And we still have this temporary antiquated solution. So that's number one. But it gets worse because the US Supreme Court in 1992, in the Quill case, they said, hey, Congress, we've had all of these cases out here. We keep, deciding issues when the ball's really in your court. This is your domain. You should be doing this. So we're going to leave it to you from now on. That was in 1992. 2018, U.S. Supreme Court again took up the issue because Congress never does anything when it comes to Nexus. So, I mean, they can't even decide what they want to have for lunch nowadays. Do you think they're going to pick up an issue that they haven't touched in 63 years and have been reminded of during this time? I don't think so. So maybe our great-grandchildren get the benefit of what Congress does today about Nexus, or a year from now or 10 years from now. But I just think for those of us who are waiting on Congress to act before we do something about economic nexus, I think we're going to be waiting a long time. All right, so a couple of other cases, Quill Corp versus North Dakota, and this is the case, one of the cases that Wayfair overturned. The reason I'm mentioning it here is because when it was decided, the U.S. Supreme Court used limiting language. And I'm going to paraphrase, but the limiting language they used said, at least for sales tax, there has to be some sort of physical presence. Now, the state said, they used limiting language, at least for sales tax. That means for other types of taxes, you don't need a physical presence. And we saw South Carolina pushing the envelope the next year, 1993, with the Jeffries case. Jeffrey was Toys R Us, and remember their logo, Jeffrey. So South Carolina said the licensing of intangibles are enough to create a substantial nexus. And this was decided in favor of South Carolina. It was not appealed to the U.S. Supreme Court or the Supreme. Actually, I don't know if it was appealed and Supreme Court rejected it, but this went out to a number of states. Some of them decided exactly the same way. These cases are referred to as the Jeffries cases. But South Carolina quoted Quill. They said, hey, Quill's just for sales tax. So yeah, this can move forward. Next case I want to talk about is Wisconsin Department of Revenue versus William Wrigley. This is the gum company. And this was about Public Law 272. It clarified what constitutes solicitation of orders and de minimis activities. And we're going to go through a lot of that's the MTC guidance I was talking about earlier, and you'll see what I'm talking about there. Before we do, let's talk about physical presence nexus. So you can have physical presence nexus for income tax and for sales tax, and sometimes it's the exact same activities that create the nexus. Now, many states, when they're talking about their income tax nexus, they say any activity not protected by Public Law 272 creates nexus. And some states are going to list their protected activities, and some states are going to list their unprotected activities. Some states, not so much. So physical presence, and a lot of people say, Mike, you don't talk about physical presence on income tax. Yeah, I am. I'm telling you, it's the same activities that can create nexus for sales tax can create nexus for income tax, so long as you're not protected by Public Law 86272. That's the big, differentiation. Yeah, I can say that. That's the big difference between sales tax and income tax. Now it's losing its protections, and we're going to go into that in a little bit. Right now, let's talk about what the Interstate Income Act of 1959 was. As we mentioned earlier, it was in response to the specifics of Northwestern Cement. And the fact pattern of that was they were selling tangible personal property that was approved outside the state and fulfilled from a point outside the state. So Congress reacted very swiftly. Within 7 months, we had this public law. As I mentioned earlier, it was the last time they moved swiftly. It was meant as a temporary solution. And the Interstate Income Act of 1959 is Public Law 86272. A lot of people say, well, 86, isn't that 1986? No, that's the 86th session of Congress. So that was back in 1959, 86th session of Congress, and it was Public Law 272. All right, and what Public Law 86272 basically says is that a state is prohibited from imposing a net income tax. That's important, net income tax, if these three criteria are met. The in-state activities do not exceed the solicitation of tangible personal property, and I'm paraphrasing here. The orders are sent outside the state for approval, and the orders are fulfilled from a point outside the state. So net income tax, that's important. So gross receipts tax are not covered by this. Has to be a net income tax. So who is protected? Well, until recently, e-commerce companies. I mean, if you were just having to register in a state because of an economic nexus, so if you had a pure economic nexus, it protected you because you're selling tangible personal property. And so long as it was a state with a net income tax, you were protected by Public Law 86272. It would also protect companies, traditional companies, even when they have independent contractors or employees in the state. If they were only soliciting tangible personal property and the orders were approved outside the state and then fulfilled from a point outside the state. And we're talking about net income tax. So it did help some companies once we started getting economic nexus for sales tax. That's changing. We'll get to it here, but the one thing that's different that is not in Public Law 86272 that was in the facts of the case was an in-state office. So Congress decided not to protect that unless it's a home office. So if you're working out of your home, that's taken to be protected. But if there's a physical location in a state, then that's generally not going to be protected. So who's not protected by Public Law 86272? Well, companies offering services. I mean, our economy is a whole lot different today than it was back in 1959. We have a lot of companies offering not just tangible personal property, but training, installations, implementations, repairs. So if you're offering anything other than tangible personal property, you're not protected. And this is all or nothing protection. So you can't say, well, only some of it is being sold with this. Companies with inventory in the state. So FBA sellers are low-hanging fruit. Because you're not protected by Public Law 86272. That's what California is saying, because they're considering these at least some of your sales to be fulfilled from inside of California if you're utilizing the FBA program. And FBA, by the way, that means fulfillment by Amazon. They have a whole network of warehouses, and They store your inventory, they pull the inventory, they pack your inventory, and then they ship your inventory for you. So that's what we're talking about when we're talking about fulfillment by Amazon. Companies selling intangibles or services. A lot of companies selling software today, which was virtually unheard of back in 1959. They're not going to be protected. Companies with a physical presence in the state, we mentioned that, and but foreign entities. A lot of states do not afford protections of Public Law 6272 to foreign entities. And their reasoning behind that is Public Law 6272 is about interstate commerce, not foreign commerce. So if you're a foreign entity, you often don't get the protection. Some people may be saying, well, Mike, what do you care about foreign entities anyway? They're protected by the Tax Treaty Act. Well, the Tax Treaty Act is, again, for federal taxes. States are sovereign, and they can follow the tax treaty, or they don't have to follow the tax treaty. And there are 13 states that don't follow the tax treaties. So that's why that is in there. That's why we're talking about that. All right, so the Multi-State Tax Commission, or MTC, is established by the Multi-State Tax Compact, which is a quasi-governmental agency, and it was formed by all the states out there. Now, the Multi-State Tax Commission, or MTC, their policies are advisory only. They are not binding. They were formed to promote uniformity. They develop models that states can follow, and they perform audits on behalf of the states. They do sometimes multi-state audits, multiple states at the same time. And they have guidelines for Public Law 6272. They were originally adopted in 1986. They were revised after Wrigley in 1993, again in 94, and lastly, before last year in 2001. And the historic guidelines are 13 protected activities, 20 unprotected activities. States, again, may deviate from that. They're not binding. And they've gone their revision process in light of Wayfair. Before we get into those protected activities, let's do our next polling question.
Yeah, that should be up on everyone's screen right now. It says model rule from the MTC is binding on member states. So a little bit of a quiz for you. True or false? Mike, it looks like answers so far are pretty split down the middle. So why don't you start going over this one, and we'll give everyone a few more seconds while you're doing so to answer.
And the model rules from the MTC are advisory only. They're not binding on any of the members. Okay, so let's look at the historic. These are the historic. So we'll go through those first because a number of states are going by these historic rules and don't have plans to change. And then we'll go into the current guidance. So soliciting orders for sales by any type of advertising, that's going to be a protected activity. Solicitation of orders by an in-state resident employee or representative, so long as the person does not maintain or use any office or other place of business in the state other than an in-home office. So very important. This can get very granular. Carrying samples and promotional materials only for display or distribution. And we're going to see this term, without charge or other consideration. If you're charging when you give this stuff out, then it's not protected. Furnishing and setting up display racks and advising customers on the display of the company's products without charge or consideration. Providing automobile to sales personnel for their use in conducting protected activities. And this is one of the things that I used to struggle with because states are so aggressive about having property in their state. And any creating nexus. But then I thought back, well, got to think this is mid 80s. In the mid 80s, a lot of salespeople were provided automobiles. I mean, they needed to go from business to business. Very little was done over the phone or the internet back then. So this was a big part of the sales process. So once I got my arms around that, it was much easier to understand why this was a protected activity. Passing orders, inquiries, and complaints on to the home office, so long as you're passing them on, then it's a protected activity. Missionary sales activities. Now, every time I say this, someone says, well, Mike, what's that? It's really simple. You're basically working with retailers on behalf of your wholesale customers if you're a manufacturer. So missionary sales activities are protected also, so long as they are only related to solicitation. Coordinating shipment or delivery without payment or other consideration, and providing information relating thereto either prior or subsequent to the placement of an order. So you're allowed to tell someone, give them whatever documentation they need, talking about the shipment and delivery, so long as you're not charging for it. If you charge for it, then it's not protected. Checking of customers' inventories without a charge or quality control. So if you're just going in and someone tells you, well, I've got 6 cases less, and you say, okay, we usually get you 20, we'll get you another 14. Yeah, that's pretty much for reorder. But what happens if you're going in and you're looking on the shelves and you're looking for dented cans and you're looking for expiration dates? Well, that crosses over into quality control there. So that is generally not going to be a protected activity. Maintaining a sample or display room for 2 weeks, very important there, 14 days or less at any one location during the state during the tax year. We're going to see why it's so important. It's very granular there, very specific. And this next one too, recruiting, training, or evaluating sales personnel, including occasionally using homes, hotels, or similar places for meetings with sales personnel. So if I'm interviewing a salesperson, that's okay. Later on, you'll see if I'm interviewing anyone else, not okay. All right, so here are the unprotected activities. And this first page here, this reads a lot like the list of activities I had up for third-party nexus. So making repairs, providing maintenance, collecting current or delinquent accounts, and whether directly or by third parties, investigating creditworthiness, installation or supervision of installation. An important distinction there. I ask people all the time, are you doing installations? No. And then I'm looking at invoices and I'm seeing payment for reimbursement for travel. And I ask and they say, oh, well, that's the supervision of installation. They're not actually doing the installation. Well, in most instances, the states don't care. Installation or supervision of installation. Conducting training courses, seminars, or lectures for personnel other than personnel involved only in solicitation. If you're only talking to the sales force, then you're okay. Talking to anyone else, not protected. And when something's not protected, that means it's nexus created. So providing any kind of technical assistance or service, including but not limited to engineering assistance or design service, when one of the purposes thereof is other than the facilitation of the solicitation of orders. So getting very granular here. Investigating, handling, or otherwise assisting in resolving customer complaints, other than mediating direct customer complaints when the sole purpose of such mediation is to ingratiate the sales personnel with the customer. Well, if I'm a salesperson, isn't every customer complaint pretty much that I handle to ingratiate me with the customer. So that one is pretty hard to distinguish. I mean, you start getting pretty granular on these. Approving or accepting orders, repossessing property, and securing deposits on sales. All right, so here are some of the current, the unprotected activities historical. They assume that you were actually sending someone into the state. They were not remote activities. You actually had someone in the state, physically in the state, doing all those unprotected activities. Not so much anymore. This is the current unprotected activities. It's the picking up, replacing damaged or returned property, hiring, training. Oh, this is the current. I'm sorry. Jumping ahead of myself here. Picking up or replacing damaged or returned property, hiring, training, or supervising personnel other than personnel involved only in solicitation. See, again, if you're doing anyone other than salespeople, hiring, training, supervising, that's going to be nexus creating. Using agency stock checks, maintaining a sample or display room in excess of 14 days. Less than 14 days, you're okay. In excess of 14 days, not okay. That's going to create an issue. Now, here are the unprotected activities. These are advised. This is what I jumped the gun on. And on November 20th of 2020, the MTC adopted revised guidance. On August 4th of 2021, the MTC adopted the guidance in the full MTC, and at least 22 states so far have said they will adopt in part or in full. So this is why we say the next 18 months are going to be really, really tough when it comes to income tax. In states like California and New York have already implemented this. So Oregon said they were they backed off. So we don't know how this is all going to turn out. But these revised activities pretty much eviscerate the protections of Public Law 86-272. I mean, providing post-sale assistance to customers via electronic chat or email access through a website. I mean, a lot of companies are doing that. Business solicits and receives online applications for branded credit via the website. Inviting viewers of a website to apply for non-sales employment. Notice here, you don't have to accept any resumes. If you just offer, if you're inviting people to apply for a job, that is an unprotected activity. And then this one here, most sellers on the internet use cookies nowadays. And the inserting of internet cookies into the computers or other electronic devices, that is going to invalidate the protections of Public Law 86-272. Selling warranty plans, and how about this one? Remotely fixing products via the internet and Wi-Fi. So it used to be you had to send someone into the state to fix something. Now, if you fix it over the internet, that is going to violate the protections. And Ellie, we want to go. I think this is our final poll question.
It is. I am launching that right now. A little bit of a quiz for everyone. PL 86-272 protects the company from a state imposing a blank tax in which scenario? A remote seller offering services from a net income tax, a company selling TPP from a sales tax, a company with salespeople working from home, and sorry, got cut off here, from a net income tax, a remote seller of TPP from the Washington Business and Occupation Tax. Mike, most people are saying a company with salespeople working from home from a net income tax. let's give everybody this question takes a little bit more time to read through. So if you want to review this one and then we can move forward, but quick reminder, you do have to answer these poll questions again in order to receive CPE credit.
Okay, we've got a really smart group here. The correct answer is a company with salespeople working from home from a net income tax. So that is the correct one. The first one is wrong because Public Law 6272 doesn't protect the company offering services, only tangible personal property. The next one, it protects companies from a net income tax, not a sales tax. And the last one is the same thing. It only protects companies from a net income tax, and the Washington Business and Occupation Tax is a gross receipts tax. So the correct answer again is a company with salespeople working from home. All right, so let's do economic nexus for income tax. Quill, we talked about that. That leads to states starting to assert economic nexus for income, franchise, and other taxes. Jeffrey really starts pushing the envelope. We had the multi-state, the MTC, introduce a factor presence nexus standard. But even then, states still had to follow Public Law 6272. So what is the factor presence nexus model? And this is what they put out. And they said substantial nexus is established if any of the following thresholds is exceeded during the tax period. The first one is a dollar amount of $50,000 of property. Second, $50,000 of payroll. Third, $500,000 of sales, or 25% of total property, total payroll, or total sales. And remember, the MTC models, they're not binding. So we see all sorts of variations of this. What the MTC is making a hard push, that along with their new guidance for Public Law 6272, they believe that every state should adopt this, that if you're going to be utilizing the new guidance, this protects smaller companies. That's what their theory is. Now, some of the states that have this right now, and by the way, it's not only states, it's some local jurisdictions. Alabama is 500,000. California, we'll have to update that number. They're one of the states that adjust for inflation. So that number changes every year. Colorado is at 500,000, Connecticut 500,000, Michigan 350. New York's at the high end. They have $1 million. We have Ohio and Tennessee at 500. Virginia's at the low end. They say any positive apportionment factor. And this is where we really have to look at materiality, because in theory, $1 in sales is a positive apportionment factor. So you got to look at that one tougher. So Washington, they were at 250,000. They dropped to 100,000. So it would match their sales tax economic nexus. Texas and Pennsylvania were two of the last states that actually required physical presence. They changed roughly 2 years ago, and they're both at $500,000 now. The state of Oregon, they've got 750,000 now. This is actually a gross receipts tax that they passed. This is not a net income tax. And it's 750,000 a million. At 750,000, you need to get registered, but you don't actually have to pay any taxes till you cross $1 million in Oregon. The city of Philadelphia, they have a $100,000 threshold. Pennsylvania's at 5, as I mentioned, and Hawaii has the same thresholds that they do for sales tax, 200 transactions or $100,000. And Hawaii is saying that you've got nexus for income tax also. Now, states where Public Law 86-272 doesn't apply or doesn't apply fully. And California, when we're talking about their franchise tax, the first $800 is a minimum tax. And after that, it becomes a net income tax. So the first $800 is not protected. For their limited liability tax, that's not a net income tax at all. So that's not protected by Public Law 86-272. And then Kentucky has a limited liability entity tax. It's not just for LLCs, it's for any type of entity that protects an owner from exposure. So C Corps are also subject to the limited liability entity tax. And they have two taxes. Kentucky has this limited liability entity tax, and they've also got the income tax. So you could be protected from the one, but not from the other. The Ohio Commercial Activities Tax, or as it's better known, the CAT, that's a gross receipts tax. The Nevada Commerce Tax, that's got a $4 million threshold, so it's only for the much larger companies. The Oregon Corporate Activity Tax, that's another CAT. That's the one we were just talking about, the $750,000 or $1 million. The Texas Franchise Tax is an actual gross receipts tax, and the Washington Business and Occupation Tax, again, is a gross receipts tax. Here are some of the most aggressive states out there right now: California, Pennsylvania. Most people don't realize this, but Florida, very, very aggressive on C Corps. On pass-through entities, they don't have a personal tax, so very rarely is there any exposure if you're an S Corp or an LLC. Illinois has been getting aggressive. And Illinois, by the way, Illinois, Puerto Rico, and Nebraska, South Carolina, these are all states that when you open up a sales tax account, they automatically will open up an income tax account. Now, Illinois, it takes an act of God to have them close it. You really, what they try to tell you is, don't worry about it. We're not saying you owe the Illinois tax. We're just saying that we want to be nice guys. Out of the goodness of our hearts, if you need it, we've already opened it up for you. That makes me really, really nervous. So I pay attention. In any state where I already have an account open, the minute that I'm subject to it, I generally want to go ahead and start filing. And that's Illinois, Puerto Rico, Nebraska, South Carolina. Texas does the same thing. Texas is extremely, extremely aggressive. They take the position everybody owes it. Those other four states, not so much. It's just a convenience for you. But Texas and Kentucky do take the position that everybody owes it. And you got to prove to them that you don't owe it in order not to have the obligation to file. All right, so what does the future hold? I think we're going to see more states follow Oregon's lead and introduce gross receipts taxes. They are not protected by Public Law 86-272. I think we're going to see other states try to chip away at the protected activities. Massachusetts says that PL 86-272 is unconstitutional in light of Wayfair. We think there'll be a challenge there at some point. The AMTC revised their guidance. Many states are going to adopt. FBA sellers are going to be a bigger target going forward because of them meeting all the requirements of Public Law 86-272, except from fulfilling from a point outside the state. So I think we're going to see more of that. And just in general, states are going to grow entirely more aggressive while pursuing income, franchise, and gross receipts taxes over the next 18 to 36 months. So in the best of times, I was projecting these things. But now I think it's almost inevitable we're going into a recession, and the states are going to need additional revenue, and they're going to start enforcing laws that they already have in the book. During the last one, that's how, resale certificates became such a big issue. It was a law that wasn't in the last one. In the last Great Recession, back 2008, 2009, 2010, that's how we had resale certificates go from a matter of fact over form to, substance over form to form over substance. They started enforcing that. They've raised a lot of money. And here I think they're going to be going after income tax. So those are some of the issues that I see. And Ellie, at this point, why don't we open it up to questions?
Yeah, absolutely. Why don't we jump right in here? So does California's franchise tax only apply to businesses that are registered with SOS in California? Does it apply? So it doesn't apply to remote sellers?
That's going to be my favorite answer. It depends. So no, it does not apply only to businesses that are registered with the SOS in California. California is one of the states that has an economic nexus. So if you have $500,000 of sales in California, then you have, it's up to 600 and whatever the current number is. But if you're over that threshold, then and the one that I have up on the screen there, 610, I think it's actually higher than that though. But if you're over that, if you got $1 million of sales, yeah, California says that you have a responsibility. It doesn't matter if you're registered with their Secretary of State. Now, they may tell you you need to get registered with their Secretary of State, but just because you're not registered with the Secretary of State doesn't mean that you're safe. So the other thing is, if you have inventory in an Amazon warehouse and you're below 500,000, they're going to tell you that they want their cake and eat it too. They have an economic nexus and a physical nexus in California. So what you consider a remote seller, what they consider a remote seller, may be two different things. And just an economic nexus is enough to create an obligation for the California franchise tax.
Thank you, Mike. Okay. What sales tax software do you recommend for a small business less than 5 million in annual revenue?
I try to stay away from that. It's I think software companies are a necessary evil, and the problem with the software companies, if you're talking about just doing the transactions, getting rates, figuring out what's taxable, they're pretty much all the same, but again, as soon as I recommend, every time I recommend someone, it comes back to bite me because, there's software companies that have to do sales tax. They're not sales tax companies. And if you're thinking of having a sales tax software company do your returns, that's the majority of our business, is cleaning up messes that the software companies make. So they're a necessary evil. There's a new company out there that I'm actually working with. It's called Tax, and that's the one at this point. If you had to pin me down, I would recommend. They don't offer any services though. So if you're looking for someone to do your returns, I would look elsewhere, anywhere else other than a software company.
All right. Okay. Why don't we, do you want to do any more questions here, Mike, or do you want to wrap up? Or right at the,
we can
right at
do
12:30.
if people want to stay around, we can do another question or two.
Sure. Why don't we do another question or two, but I'll say this in case people need to head out. Thank you for joining us. Please keep an eye out for those new webinars. We've been having a great time with the first 4. We love to see all the new faces and returning faces that joined us. The next couple weeks, we have a couple state society events that we'll be at. So if you're in Minnesota or South Carolina and headed to their state society events, look out for us. We'll be there. We'd love to say hi. And yeah, let's do a couple more questions. So Mike, does FBA inventory in California create income tax nexus for a Florida C Corp?
California takes that position, yes.
Right. And I'm not sure I can quite decipher this question, but maybe you can. As to drop shippers, how states are treating in regards to sales tax and income taxes.
I'm not sure what the question is, but the answer is it's going to be, it depends. Each state, has their own rules for drop shippers. If you're generating income from a state, and you're over the thresholds or have a physical presence there, then you would be subject to income tax. And same thing with sales tax. I mean, drop shipping counts in most instances. I mean, if you're drop shipping through a marketplace, there are different rules for that. So go back to depends, but you don't get to exclude sales for when you're for drop shipping from most of your, you may get to exclude them from marketplaces, but you don't get to exclude them for just regular drop shipping. That's not through a marketplace when you're calculating the thresholds.
All right. And Mike, anything else you want to add in here before we close up?
No, appreciate everyone joining us today, and hope to see you on future webinars.
Thanks, everyone.